Welcome to Roth Crash Course. In this class, I'm going to be discussing a brief overview of what's new with your 457B plan and talking a little bit more in depth about the designated Roth that's now available for you. My name is Lisa Dawson. I'm a financial advisor with Scissortail Advisory Group. Our team has offices in Oklahoma City and Tulsa. Rebecca McGee and I are located in Oklahoma City. We also have Angela Diamond, our office administrative assistant here in Oklahoma City with us. And Jessica Spencer Price is our financial advisor who offices in Tulsa. You've likely seen us at some of the events around the city, and we're here to help. If you'd like a one-on-one individual meeting, we can schedule that. You can give us a call at 405-568-2889, or you can visit our online scheduling app, which is okc.timetap.com, to schedule a phone or a Zoom meeting with us. It's important to understand how and when to get your money from your 457 deferred compensation plan. When you separate from service from the city of Oklahoma City, you are able to take withdrawals. It's not going to be an age 59 and a half rule typically with your 457. And we also want you to understand as we speak today that we're going to be talking about some things that are related to taxes. We don't provide tax or legal advice, so you might want to talk to a tax professional about those specific questions for your situation. Investments are not FDIC insured and they're not guaranteed, so they may lose value. We can help you understand your investments and educate you on different options available within your plan. And we can help you with retirement planning, pre-retirement planning, and different stages of your financial life. Our role is really just to help you simplify. We want your financial life to be as stress-free as possible, and we're here to help you. We can help define goals and take your next financial steps. We really want you to be able to focus on what matters most to you and your family. One of the biggest and most common questions that we have is confusion surrounding individual retirement accounts like Roth IRAs and the 457B Roth that's available now within your deferred compensation plan. There are some similarities, but there are key differences. One of the main differences being how much money you can contribute each year. The 457B is considered a designated Roth by the IRS. And as such, it allows you to contribute a much higher annual limit. These limits do change each year. We can also help you understand age-based catch-up limits and determine how much per paycheck that you would like to contribute to try to reach your maximum goal. A Roth IRA has a lower limit and a lower catch-up limit. It also has an income phase-out limit for high earners. High earners, in short, at some point may phase out where they can no longer contribute to a Roth IRA, but that is not the case with the 457B Roth. If you're a high earner, you can still contribute to that 457B Roth, and we can help you understand the nuances of that as well. There are also some key differences when it comes to consolidation. A lot of folks want to consolidate external retirement accounts, and we can often help with that. We usually ask to review a statement so that we can make sure that the money can move over and the pros and cons of doing so. But it's very important to understand the IRS rule does not allow you to roll a Roth IRA into your City of Oklahoma City 457 Roth because of the slight differences in those two types of accounts. Once you separate from service, if you decide that you want to do a roll out of the 457 designated Roth, it can roll out to a Roth IRA. And we've got some materials available we can send you in an email and provide to you in a meeting or a phone call if you have some more questions about consolidation. We're happy to help. There is still a age 59 and a half rule when it comes to Roth. We'll talk about that in a little bit, as well as a 5-year participation rule to be able to receive federally tax-free distributions from Roth. And that's another big question that we get a lot of time is how can we take this money out and not have a tax consequence with Roth? The tax choice available to you now is traditional pre-tax 457B Roth option, where you can contribute from your paycheck before taxes. Those earnings are tax deferred, And then eventually, when you start taking withdrawals, you're going to have some taxes due on both the contributions that you have made because you haven't been taxed yet on that money, and then also any gains in there. But now there's also the Roth 457 option where you can choose to pay your taxes now on your income, contribute that after tax to the Roth. The earnings are also tax deferred. And then eventually, if you've met the qualifiers for the IRS rules for qualified distributions, your gains could be federally tax free. You can contribute pre-tax Roth or a combination of both up to those limits that I mentioned earlier. And it's really up to you to decide for your situation what works best. Most folks consider traditional pre-tax 457 if they like taking the benefits now for the current tax deferral. It reduces your taxable income the year that you contribute, so that can give you a tax break now. If you need to take home as much of your pay as possible, pre-tax may be a good option for you because those funds, again, are not taxed. You make the money now, you contribute it pre-tax to your 457, and it can help you a little bit on your take-home pay. Or if you think that you might be paying lower taxes in the future, for example, after you retire, if you drop down to a lower tax bracket, then the pre-tax option may make sense for you. You want to consider a Roth or an after-tax contribution if you like the idea of potentially having some tax-free income when you take withdrawals from that qualified Roth bucket. That might be a good choice for you. Or if you're confident that your salary is going to be increasing over time, and also if you can afford a reduction in your take-home pay. Because the Roth is taxed up front and then contributed to your 457, there's going to be a slight difference in your take-home pay that we'll talk about a little bit later. You might want to consider both options and do a combination of some pre-tax and some Roth. If you're just not sure whether your taxes are going to be higher or lower, I mean, let's face it, Congress changes laws and tax rates can change and different things come about with different administrations. There's a lot of unknowns there. So if you're not sure or you just want to diversify and have different strategies at retirement and different income streams to pull from, it might make sense to do both. And if you still need to take a little bit of a tax break, then you might want to consider doing pre-tax as well as Roth in a combination. You can crunch the numbers, but the real basic from this, if you're contributing $100 pre-tax traditional to the 457 and you want to know, how do I make sure that my take-home pay does not change? I really want my take-home pay to be the same. If you're doing a $100 contribution, the equivalent in Roth would be about $75. So you'd back off your contribution to Roth and switch that from $100 to $75. Your take-home pay should be about the same. But again, you could do $50 pre-tax and $50 Roth. And what I always tell folks is you can ease into it and you are in control. You can increase and decrease your contributions right through the website. You don't have to set up a separate account for the designated Roth option. You will go into your website, log into your account, you'll click on the contributions and update. And right there, you can see an opportunity to choose pre-tax, Roth, or a combination of both. Submit and move forward. It's going to take about 1 to 2 payroll cycles for that change to take effect, so just keep that in mind. But you are able to log back in and make a change if you need to, just to make sure that your budget is still where it needs to be. And we can help with that. If you're just not sure and you want us to crunch the numbers for you, that's why we're here and we're happy to help. So how does it really work? If you are a participant who made $50,000 for the whole year, and you have contributed per paycheck all year long, and the total was $5,000. Your taxable income is not $50,000, it's reduced because you've chosen to do the pre-tax contribution. So it's like the IRS ignores that income for you. $50,000 minus 5 makes your taxable income $45,000. For the purposes of this example, I used a tax rate of 25%. If we tax that income at the 25% tax rate in this example, then the actual taxes that are paid from your income is $11,250 when there's no money going into that Roth in the 457. So your take home pay for the year would be $33,750. Of course, we're not including any other deductions or anything like that. We're just going to keep the math as simple as possible today. Now, on the other side, if we do a Roth, same numbers, we take $50,000 annual salary, you contribute all year to your Roth. There's no reduction in that taxable income for the year. So you don't get a tax break now. You're paying the taxes on the total $50,000 salary. And so your tax rate at 25% is taxed on that 50,000, which means your taxes are 12,500. You have also contributed 5,000 to your Roth. And so your actual take home pay is 32,500 in this example. So that's where we talk about how, to make some adjustments if take home pay is super important for your budget and you need to make sure that stays consistent for your family. For 2026, the 457B normal contribution limit is either 100% of what you make or 24,500. For example, if you only made $20,000, you wouldn't be able to put 24,500 in your 457. But if you make more than 24,500 and you are under age 50, 24,500 is your number. And that, again, can be pre-tax, Roth, or a combination of both. A lot of folks want to know if they start doing contributions to Roth, how do I see my Roth money? Because they've been making contributions and they log in and they can't see it. We can help you. You'll be able to log in and view by source and see where your Roth dollars are designated and where your pre-tax dollars are in your account. There are age-based catch-up limits in addition to your normal contribution. And again, these age-based limits apply whether you're doing pre-tax, Roth, or a combination of both. When it comes to investing in your 457, contributing to Roth does not change your investment allocation unless you log in and make the changes yourself. In other words, those Roth dollars are designated and it goes into the same investment elections that you've already chosen for your 457 pre-tax traditional. All of those dollars are going to be going into the same 457B account. So there's no reason to set up or no need to set up a separate Roth account. Again, I mentioned earlier, all you would need to do is go to your contributions tab when you log into your site and select how much money you would like to contribute per paycheck and whether you want to do that on a pre-tax basis or a Roth or a combination of the both. When it comes to your investment mix, you have choices and we're here to help. If you don't understand the options that are available, if you have goals and you're not sure if you're on track, if you want to make some changes because of the market and you're just unsure what to do, give us a call. We're happy to help with that. In short, you can be as aggressive or conservative as you choose, and you can make those changes right through the website. We talked a little bit about how to get your money from the 457. There's very limited access to the 457 retirement money while you're still working and actively employed. There are some circumstances where you can take a hardship withdrawal, but it's very tricky, and we would recommend that you give us a call for help with that. It really needs to be seen as a very last resort, but it is an option that's available to you. The 457 does allow you to start taking an in-service withdrawal if you're still actively working beyond the age of 70 and a half. And then, of course, if something happens to you, your beneficiaries would be able to present the paperwork, the claim form, and we can help with that as well. Whether it's pre-tax or Roth money, when you separate from service, you can take a withdrawal and you will have a choice. You can choose whether you take a withdrawal from your pre-tax, whether you take a withdrawal from your Roth, or maybe a little from both. The key thing with the designated Roth is that 5-year holding period. It's sometimes also called a participation period. And that is an IRS rule. You want to qualify for the best tax treatment possible for your Roth. That 5 year holding period clock starts the day that first dollar goes into your 457B Roth. It doesn't matter if that dollar goes in January or September or December 31st. If you contribute in 2026, that's year one for your designated Roth 5 year holding period. Roth IRAs and designated Roth have a 5 year holding period and an age 59 and a half rule when it comes to taking tax-free distributions. And so that's the important distinction there. Can you get your money from Roth before then? Yes, you can. But if it's not meeting those IRS rules for qualified distribution, you may be taxed on those gains. And so that's where we recommend have a strategy, and we can help you understand that strategy, because taking withdrawals from Roth too soon can really impact that long-term growth and can impact your goals. Once you've had Roth dollars for 5 years or longer and you're over age 59 and a half, if you've got some gains in there, that growth can be potentially federally tax-free. And there's very few things where your money can make money and you're not taxed on that. But Roth is the vehicle for that. And that's why it's become so popular. There is an option that has been approved by the board for the City of Oklahoma City Deferred Comp, and that is switching your pre-tax to Roth. That's the terminology that we hear, is switching our pre-tax to Roth. What it really is a conversion. You're taking money that has not been taxed yet and you're converting it to Roth, which is a taxable event. That is not yet available. It's coming to the plan soon in 2027. More information is going to be available to that for the options and for the rules, most likely toward the end of this year. We're happy to help understand the different tax consequences to that, how those taxes are paid, and what the potential pros and cons would be to doing that conversion of your pre-tax money to Roth. When you log into your account and you have pre-tax and you have Roth money, when you first log in, you're really going to see everything in one bucket, but it is designated separately, kind of in the back inside. I mentioned being able to view by source, and we can help you with that. When you log in and you click on contributions, you're going to be able to see a menu that pops up once that page loads, and you can view by fund, by source, and vested. By clicking those links, you're going to easily see how those funds are separated, so you can determine how much balance you have that has been taxed already in Roth and how much money is tax deferred or pre-tax. But when you first log in, you're going to see your total balance all together. So for our example, it was 350,000, but there is going to be a split. You're purchasing the same investments as I mentioned earlier. And so when it comes to the gains that you have, the growth, the compounding, you're really not affecting that by changing to Roth, because those dollars are going into the same investments and buying the same shares that you've chosen all along. Long-term growth is what matters. We talked already about distributions and taxes. If you have any questions, if you're not sure about your individual situation, we are happy to help. Bottom line, if you have pre-tax and Roth money, you have some strategy that you can use when it comes to designing your income streams in retirement. When you separate from service, you can choose to leave your pre-tax money deferred up to what is called an RMD age, or required minimum distribution. That's basically when the IRS says it's time to start paying us some of our tax dollars. And when required minimum distributions start, you have to take those every year. So all of your pre-tax money will eventually be taxed. Well, what does that mean for you? Well, it means that if you are Sue and you have Roth dollars and your balance is 126,500, it doesn't matter what the tax rate is, because you've already paid taxes on your contributions. So you know that you have $126,500 to spend and generate as income throughout retirement. But if you're Joe and your balance is 156,500, but it's all pre-tax traditional money, you don't have 156,500 to spend because whatever your tax bracket is, when you start taking withdrawals, every dollar from that pre-tax is going to be taxed as ordinary income, just like it is when you have a paycheck from your job. When you generate a paycheck from your pre-tax money in the 457, every dollar is taxed coming out. And so you have to think about that when it comes to strategy. And that's where maybe having a little of both could make sense in your financial situation. You likely have more questions than answers at this point, but we don't want to take up too much of your time on a video. If you'd like to schedule a meeting and understand your situation a little bit better, make sure that you're on track for retirement or maybe rebuilding from a life event that has maybe set you back a little bit, we're here to help. Just to recap, there's similarities but key differences between the 457B designated Roth and Roth IRAs. Your investment choices are the same, regardless of whether or not you choose to contribute pre-tax, Roth, or both. Distributions from each portion of your account is treated differently by the IRS, so it's important to understand and plan accordingly to make sure that you reach your goals. And we are, as always, here to help. Again, it's very easy to reach out. You can give us a call, schedule a one-on-one in-person meeting at our Oklahoma City office by calling 405-568-2889. You can also email. We'd love to hear from you. If you would like to look at available appointments and grab an appointment, again, that site is okc.timetap.com. And you can go right on and choose a day and a time that works for you from our availability and get that meeting on the calendar. Thank you for spending time with us today and watching the video. I hope it's been informative. If you have more questions, feel free to call us. Thank you so much. Have a wonderful day.